Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, help to make it actionable, understandable, and clear. What a week, and therefore, what a show. We have some excellent data for you. A friend of the show sent an incredible, a voluminous amount of perfect financial data that will help us all become better investors and think more rightly about the market generally. We also have a Wall Street Journal article about Nvidia. We are reaching new heights with Nvidia. I know we've talked about it of late, but it bears repeating. And then as time allows, many of you know Warren Buffett's letters are historically a recommendation of mine for folks that want to learn about investing. We'll talk about a Wall Street Journal article that summarizes them a bit. But at the top, data. And you know who you are. You send us incredibly helpful data. I want you to listen to this. This is from the X.com platform. $100,000 invested in January of 1980 would have reached the following values by October of 2025. That's today. Now, I want you to bring the children and grandchildren, aunts and uncles around for this one, because this will shock you. Now, some of these we'll have to put an asterisk by. I can't verify, but in 1980, for the financial historians, you'll recall that was an interesting period in financial history. Interest rates, commodity prices, a savings account. Again, $100,000 invested in 1980 would be $700,000 in a savings account. Gold, $770,000. It was a peak in gold in 1980. 10-year treasury bonds, $1.3 million. I bet better than you thought. Check this out. Tokyo real estate, $150,000. If you invested $100,000 in January of 1980, present day, 45 years later, you're at $150,000. Now that hurts. That hurts. And it was at a peak then. Madrid real estate, $560,000. New York real estate, $1.1 million. Paris real estate, $1.2 million. Sydney real estate, $1.75 million. London real estate, $2 million. College Station real estate, priceless. Just kidding. I'm just naming all the financial centers and major power players in the country. Had to put College Station there. The S&P 500, $10.6 million. Again, $100,000 in 1980 is $10.6 million. And then they do some individual. IBM, $8.8 million. That includes dividends. Apple, that's probably what you're looking for. What would Apple be worth? $214 million. So that's a 45-year snapshot. And again, a whole lot is determined by your starting point. January of 1980, it was a high point for commodity prices. So gold did not do as well. It was, Tokyo real estate was very expensive. So you did not do it. You basically stayed flat 45 years later, which mirrors their stock market. And then, if that wasn't enough, you look at some of the popular stocks in 1980, people would have heard of. Pan Am Airlines. If you invested $100,000 in 1980, it's worth $0 today. Kodak. If you invested $100,000 in 1980, it's worth $13,000 a day. Bummer. Texaco. $100,000 in 1980 is $200,000 today. AT&T got up to $2 million today. IBM $7 million. Coca-Cola up to $35 million. And Walmart. Boy, the Waldens did it right, didn't they? $347 million. So what lessons are there? When I see this, I'm just kind of shocked. One, be careful about anchoring to real estate. As Americans, and if you're a Dallasite or one of these Sunbelt markets, you might be thinking it's all about real estate. But you look at some of this data, 45 years, Tokyo, that's a tough deal. It's not impossible that it couldn't be you. So, of course, no surprise, I come back to, what's the answer, Robert? Do I just put my money in Apple? We don't know. I wish I could tell you I had a crystal ball. What makes sense to me is a low-cost global ETF index fund, ticker symbol VT. Because I look at all this and I say, gosh, I bet Kodak did look pretty good in 1980, even though you lost money over 45 years. Be very careful about individual security selection. Very careful. And of course, what a beautiful transition to Mr. Peter Maluk. Check this out. I know this horse has been beat to death, shot behind the barn, whatever you want to say, but we can't say it enough. Maluk comes out this week on the X.com platform. He says only 22% of active funds have beaten the market year to date. The worst performance in at least 26 years. Now, hold on. Hold the phone. Source of this data is Jefferies. Now, wait just a second. I was told that the more people index, the easier it would be for all the stock pickers to beat the index. But this data shows no, it's the worst in 26 years. That's going back to 99, kids. Maluk then gives one of my favorite Jack Bogle quotes. Don't look for the needle in the haystack, just buy the haystack. So if you are in the stock picking business, you have to stare at this data and say, okay, I thought this was supposed to be getting easier as the quote unquote dumb money is indexing. Because I'll tell you, listener, all the stuff I read is pejorative related to us indexers. We are Luddites. We are followers. We're not aiding in price discovery and therefore contributing, so they say, I disagree, to an inefficient market. However, what's happening in practice? The market's more efficient, more difficult to beat. And why would that be? Have you ever wondered that? How could it be that the more people index, which is happening year over year, more and more and more money is going into index funds? Why is it getting harder? Shouldn't it be getting easier for the active funds? Well, another Jack Bogle quote. He says, dumb money ceases to be dumb when it recognizes its limitations. I'll say that again. Dumb money ceases to be dumb when it recognizes its limitations. And what a lot of people are doing, retail and institutional, is they're saying, we've had enough fun on the merry-go-round of active investing, and we're going index. And many of them were not great at picking stocks. So who's left? Class? If everybody else is throwing in the towel, all the sharks. You've got a bunch of sharks and a bunch of index funds. You got a bunch of AI bots trading on a 10Q that was released that they read in 1 second that your human eyes could never see. It's very efficient out there. Very, very efficient. Don't take the bait that it's getting inefficient, and therefore you need to ditch your index funds. No. Another interesting data point, and this will sober you up to stock picking as well. This is B of A Research put this out. This is from the X.com platform. All net wealth in the U.S. stock market since 1926 has been generated by just 3.44% of companies. I'll say that again. All net wealth in the U.S. stock market since 1926 has been generated by 3.44. To put this differently, 97% of all stocks have barely contributed to long-term shareholder wealth creation. The top 1.88% of companies reflect 90% of total gains. Interestingly, just 0.26% of firms have created half of all wealth. That is extreme concentration, listener. A lot of people read this and they go, oh, cool. I'll just pick the right stocks. Not the application I'm looking for. If that's your answer to this data, I'd tell you, you're going to have to find a very, very, very small group. 3.4%. And there's an even smaller group that hit the home run you want. 0.26% of firms have created half of all wealth. Okay, so that means you've got 100 quarters in a jar. You shake them up. You pick one out. You got to pick the right one. And it's even harder than that. It's more like 400 quarters. But that just shows, that's how hard it would be to actually pick the right stocks. And then, and you can't just pick them. No. I wish it was that easy. I wish we could just pick them. You got to hold them. And you got to believe that it's the right stock. The last two data points I've given, one related to active funds and two related to concentration, I think it's a nail in the coffin of active mutual funds. It is evidence that demands a verdict, and that verdict is not worth it. Not worth it. So you know what to do. And then Mr. John Luskin, who's on the X.com platform, gave what I feel is one of the more wise statements of the year. He references a Morningstar study, Morningstar being a group that evaluates markets, is in the mutual fund business, but does research. He says this, and he's like me. He says he works with do-it-yourselfers. He's a financial advisor. I work with do-it-yourselfers. He says for the most part, folks will maintain their investments themselves. And having worked with, he says, 455 households, I can tell you that practically no one does that maintenance. So he's saying people think they'll do it themselves, and then over time they don't. What Luskin says, he says, therefore, over time, I found that it's increasingly important that a simple, low-maintenance investment plan be the default. Ding, 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 ding. Genius. So while one could argue, he says, that you could use all sorts of complicated strategies to increase results, that's theoretical. Bingo. This is real life. Practicality is what matters. A Morningstar study shows that those with single fund portfolios do better than those with more complex approaches. That means if you a target date fund, which I like for the tax advantaged accounts, 401k or IRA, much better. Couldn't agree more. Could not agree more. I don't care how sharp a person you are. I think over time, like a lot of stuff in life, it's like getting your estate plan sharpened up. People just don't do it. There's always tomorrow. Always tomorrow. So be suspicious of the perfectly curated, optimized financial plan with just the right securities, just the right fix, the right percentage. It just, my head hurts sometimes. People say, I'm going from 60% stocks to 63% stocks. Really fine-tuning it, German engineering here. Doesn't matter. Does not matter. Just stick with something. Make sure it's low cost and simple. Long time horizon, but just stick with something. And as Mr. Luskin said correctly, the single fund is tough to monkey with. Nothing to do. Nothing to adjust. Nothing to rotate. I think it's been a great advancement in financial intermediation. And then there was a Morgan Housel interview that I saw on YouTube I'd like to share with you. He has a new book out called The Art of Spending Money. I've not read it. Maybe you should. I like most of his stuff, but he keeps hammering this quote home, and every time he says it, it's a light bulb for me, which shows how much I need to learn. He says this. He's trying to earn average returns for above average time periods. Listen to that again. He's going for average returns over above average time periods. Isn't that kind of just a mind meld for the American mind? Gracias for my listeners in Spain. But a lot of these American minds, the way we think is, no. I want to maximize my return every year. Every year. Great. So I don't want an average return. I want the very best return I can get for 50 years. Well, that Morgan Housel rightly understands that's going to introduce a lot of risk into your life. And as John Luskin mentioned, a lot of problems with your fine tuning, a lot of problems, a lot more complexity. But so every time I hear that quote, it kind of puts me in my chair and I can breathe a sigh of relief and say, okay, I just got to be average. I can do that. I can be average. Isn't that a great bumper sticker? But what's hard and what's going to put you in the top 2% of investors, this is the next part, for an above average period of time. Very, very, very few can do it for 50 years. Very few. But that's the secret sauce. That's what's going to keep you from trouble too. And then Nvidia, I'll speak briefly as I see the producers hitting the clock on me. Nvidia becomes first $5 trillion company. Shares have been boosted by the AI boom and a flurry of new deals by Hannah Aaron Lang. What she does is just walks through how large this company is now. Nvidia is now larger than AMD, ARM Holdings, ASML, Broadcom, Intel, Lam Research, Micron Technology, Qualcomm, Taiwan Semiconductor combined. Its value also exceeds entire sectors of the S&P 500, utilities, industrials, and consumer staples. That's insane, listener. That is nuts. And if you thought, oh, it's a bubble, we must sell. I don't know what you call a bubble. The company's shares trade at 33 times next year's projected earnings, compared with 24 for the S&P 500. So that's higher. Tesla's trading at 210. Palantir is even higher. So the earnings are real, listener. I wish I could just tell you, oh yeah, they're betting on the future. Not so. I mean, of course, in part, but not entirely. So if you're an indexer, do you know Nvidia went public in 1999? So if you bought VTI or the equivalent mutual fund at the time, you rode it all the way up. All the way up. And if you were a stock picker in an active fund and you missed Nvidia, you remember the data, you remember what percent represents the wealth? 3.44%. If you missed Nvidia, you're going to lag the index. You're not going to be. I think this could be in part why only 22% of active funds beat the market. If you were underweight Nvidia, let's say you bought Nvidia but not enough. Did you know that Kathy Wood, the great futurist investor from ARK Investing, she sold her Nvidia position before the run-up? Sold it. And so did Mr. Sun out of Japan, who's a great futurist investor. They missed who are we? Who am I? How could I predict it? I'm not going to try to predict it. I'm going to buy the whole haystack and let it ride up. Let it ride up. Save yourself the trouble. Spend your Saturdays watching the Aggies win football games, not reading 10K and 10Q reports. Winning, a lot of winning going on there. And then in closing, Karen Langley. I read all 59 of Warren Buffett's annual letters. These are the best parts. Am I suspicious that Karen Langley read every word? I am. Because one of the most studious people I know attempted the feat, and their head started hurting when he started getting into detail of the insurance business. You know who you are if you're listening. Very proud of him for the attempt. But what I should have given him was this article, which I recently did. There are some highlights. I'd like you to do the highlights. So it doesn't always fit with our philosophy, but I like this one in 1987, February. He says this: occasional outbreaks of these two super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable, and the market aberrations produced by them will be equally unpredictable, both as to duration and degree. Therefore, we never try to anticipate the arrival or departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy, and greedy when others are fearful. I actually try to be even more modest than that. I just try to buy every year. Dollar cost average. Don't even think about it. Don't succumb to either fear or greed. Just have a plan, stick to it. Don't be a gambler. Be a farmer. Be a farmer. And there are a ton more great ones in here. I'll put this in the link, but we know, don't we, guys? As much as, and Warren Buffett loves our philosophy. We'll try to get him on the show one of these days. But amidst all the truisms that Buffett gives us, we know the one that's our favorite. That's to keep those costs low, that investing simple, and that time horizon long, because that is going to give us the best shot on our investing journey. Until next week.